Well, good morning, everyone, and welcome to Module 4 of the Raising Capital Seminar Series. I'm Mike Caldwell, Greater Des Moines Partnership. JD, if you want to go to the next slide. So we have with us,
Oops, sorry, Mike. Happy Mouse.
You're getting a little ahead of you.
Happy Mouse.
I'll let JD talk more about his background, but I've known JD for the 14 years I was working at the partnership. I consider him a friend. We're co-investors in a seed fund. He has been a huge part of a lot of the deals I've been involved with. And when I have cap table questions, he's the guy that knows it. But he does so much more than just that part of the deal. He has been a great advisor to startups, has helped with structuring a ready to raise capital, does a lot of buy-sell transactions, especially when startups are getting acquired, and helps people with closing larger rounds of capital, which I've seen that happen, and he provides great benefit. If you'd go on to the next slide. So this is a group of 3 companies getting together to do this series. It's the Greater Des Moines Partnership, LWBJ, which JD represents, and then BrownWinick Law, who has been a wonderful partner of ours throughout the years. Both these companies are investors in the partnership and give a lot of their time, quite frankly, without fees. So welcome to you all. Thank you for joining us. We prefer, if you can, while you're not asking a question, whatever, to mute your microphone. Please leave your video on. After over a year of doing Zoom calls, we all need to see some happy faces or at least someone moving out there. So we ask you to open up the chat window. That way you can ask questions as you go along. Quite honestly, if you have a question, interrupt us. We would love to have this as interactive as possible. So please ask your questions, interrupt us, etc. As always, there will be a recording available after the fact. We have a Raising Capital page with the Greater Des Moines Partnership website that's kept up to date with latest videos, latest content decks, all that's always out there for you. So today's agenda, we're on Module 4, the cap table. We got a little out of order with our seminar series this year. We will be doing Module 2 on, I believe, Monday, if I remember my dates correctly, and Module 5 on next Thursday, all at the same time. So with that, JD, you want to go to the next slide?
We're there.
I will turn it over to you and mute my mic.
Yeah, no, thank you. Hopefully you can all hear me. I'm JD Geneser. I'm a senior partner with LWBJ. You could obviously read my bio. We're a CPA consulting firm, audit, tax side, and then on our capital advisor side, we do consulting and investment banking. I do a lot of M&A based transactions and then work with a lot of early stage companies on capitalization. About 90% what I do is transaction related. And like Mike said as well, I'm also a partner in an investment fund called Mango Seed. So we vet a lot of deals as well. And then obviously from the partnership side with the Greater Des Moines Partnership, our firm LWBJ and BrownWinick, we're very, very pleased to be involved in this and work hand in hand a lot with BrownWinick. And I believe next week or the following week, Jolie will be presenting the term sheet. And a lot of what we're going to bump up against today on the cap table has a lot to do with the term sheet as well. So we'll keep it at a kind of a high level on some of the terms with regard into the term sheets and all of that, but we do want to cover some of that. So what's a cap table? Cap table is, as in the simplest terms, is a list of your company's securities, stocks, options, warrants, etc. It tells you who owns what. We're going to preach constantly today that you must always keep it current. It really is. It is the way. Not only is it the ledger of who owns what, but it's also ways to help you make really, really good decisions. I will say today, there's really no right or wrong way to format your cap table. It's just your comfort. There is math involved, and we're going to go through some math today. But how you lay it out is really at your discretion. You'll see how I choose to lay things out. It always helps me. I go round by round and really kind of, try to document each round. But there's really no right or wrong way to actually lay it out. It's just as long as it's accurate and well documented. To that A cap table should be always tailored to your corporate documents. That's the other thing we're going to preach on a lot, is make sure all your documents align with who owns what and paper everything that you do. And again, it's a powerful planning tool for future raises, and we'll take you through some of that. Again, keep it current at all times. If you're in a process of raising capital, if you're in a process of selling your company, if you're in a process of maybe issuing options, bringing new employees on, it really doesn't matter. It's going to be always required in the diligence process. So make sure it's always current and always properly documented. The nice thing about a cap table, if it's structured properly, it helps you run scenarios. Maybe you're looking at pre-money valuations on new financing or future rounds of financing, the dilution impact of different sizes, how much you raise, and then really the impact of if you want to create an incentive pool, option pool, et cetera, for employees. It really is a planning tool. It really helps you look at, your impact of your dilution if you're a founder, the investors' dilution as they've come in. Maybe you're raising a round and you're trying to position it with the current investors. They want to always see kind of who owns what and what's the impact of any future financing or future event. And before I move on, to Mike's point, we truly want this interactive. So at any time, don't hesitate to ask questions. Mike's going to run the chat room for me, and I appreciate being interrupted at any time. I'm going to cover off some common terms. Like I said, some of these will be in the term sheet as you review that in the next module. Common terms of just shares versus units. Corporations issue shares, LLC issues units. It's just the vernacular. Rounds or series, it just really defines a specific financing event. Founders rounds, friends and family, seed rounds, Series A. It really is just the definition. Now, basically, some geography changes with regard to what they call a seed versus a Series A. We've seen a lot of what we would used to maybe call Series A rounds in the Midwest really kind of get pushed back to seed rounds. Series A is usually defined really more the institutional rounds. I have a client that's currently in a Series E. So really beyond that is just really kind of the series rounds where usually you're bringing in more sophisticated investors and who tend to drive more onerous terms, preferences, et cetera. But it's really, again, it's just the true definition of whatever that specific financing event is.
JD, we actually have our first question, and now is as good a time as any.
Yeah.
If you look in the chat. What are the implications of oversubscribing a round? And there's the dilution factor, but how do you figure out if it's a good or bad idea to oversubscribe?
Well, I mean, it's a really, really good question, and we're going to actually touch on a lot of that as we go through this process. I'm always a big believer in raising the capital that you need. A lot of times I'll meet initially with clients, and they say, I'm going to go raise $2.5 million. Okay, or I'm going to raise $5 million, or I need $1 million. And the whole point of that is, okay, let's run through your model, let's run through your financing, let's run through your capital expenditures, let's run through everything, and let's really understand what the use of funds are. I've had a lot of clients get into oversubscribed situations, and generally it can be a very good thing. It's a good sign that people want obviously to invest in your company. The danger is the dilution impact and where you are, particularly if you're very early stage on valuation. Generally valuation, we're gonna kind of touch on that. Hopefully it's always rising, and therefore in the early stages you're probably at a lesser valuation, more impact of dilution. So we're very, very cautious about not necessarily going too far in oversubscription, but a lot of times we definitely allow it. It's really specific to each situation, and depending on the timing of the round, whether you're in like a Series A and you already have a very significant high valuation, or if you're at friends and family, and all of a sudden that oversubscription starts to really dilute the founders. It's really kind of just analyzing each specific situation. But generally, it's a positive sign that people and Joe will probably talk about that, or whoever's doing the term sheet next week about that. Generally, a lot of times when you're doing the documents on the investment side, you do allow for some oversubscription. Okay, I'm going to kind of keep going on some terms. We're going to talk a little bit about these today, and they're very common terms, but I'm just going to keep it at a very high level. Pre-money is just simply the valuation prior to your financing round. It's the value you're putting on your company going out to, entice investors to come into your round. A lot of times pre-money is set, particularly at the institutional rounds by term sheets that actually come from the investors. In the early stage, the company tends to set the pre-money valuation. Post-money is basically the valuation after the round. So looking at this again, if a company is setting a pre-money valuation of $4 million and they raise $1 million, the post-money of the company is $5 million. And simple math says that, if I've raised $1 million at a pre-money of $4 million, my post-money is $5 million. Therefore, I have really sold 20% equity interest in my company, or if you will, 1 million into 5 million. Recapitalization and down round, we've seen it, it does happen. What really that means is, you've raised a round at a certain valuation, whether it's maybe you were a little too high on that initial valuation, or the company's had some struggles or issues. You're back out raising money at a lesser valuation than you had previously raised. We're going to walk through an example of that. Options warrants, really that is just a lot of times options are used as incentive. Warrants are sometimes tied to investors, but it's really the right to buy stock or units at today's market price in the future. And we're going to show some examples of that as well as we move forward. Common shares are usually, founder shares, preferred shares are usually later rounds, basically tied to preferences, whether it be, liquidation preferences, whether it be governance preferences, dividends, interest, etc. Liquidation preferences, we're going to talk a little bit about, but really what that really means is I have my right to get my money out first before anybody else gets their money out. And we'll walk through that as well. Common term is waterfall analysis as well. And what waterfall is really the analysis of if a company has an event where there's a liquidation, whether it be a very positive liquidation like a sell of the company and or possibly a liquidation of the company as well because it's in distress situations. A waterfall analysis is just taking the current ownership, the cap table, and analyzing who gets what out of those proceeds. And we will walk through that as well.
JD, if I can just drop in for a second, I think, one of the things you'll hear about down rounds, you always hear it spoken on very negatively. And while it can be negative in a short term, I've seen some companies do quite well after having a down round or actually, recapitalizing the company. And we can talk about that later, but, starting over almost, right? But it's part of what happens sometimes. And I think that you'd be surprised how many success stories there are coming out of a down.
Yeah, I think that's well said. There's many reasons for a down round. Like we talked about, a lot of times, we'll get into it a little bit, but a lot of times, that initial friends and family or seed round gets just too high of a valuation initially, and everybody believes in it. And nothing to do, the company could be forming greatly, but the fact is they just raised money at a little too high of a valuation. And we've seen, great outcomes from a down round, to your point, Mike. Some types of investors, you've probably all heard these terms. Accredited, really all that is it's an individual that passes an income and net worth test. Generally allows for some security exemptions for the company raising the capital. A lot of times you'll see that only accredited investors are allowed. It tends to lead the fact that these people are a little more maybe sophisticated, but also have the wherewithal to be able to lose the money. Friends and family is just that. It's the initial round where it's, associates, friends, family members that, believe in the idea, have personal relationships with you and come in and initially fund the company. An angel is kind of back to the accredited. An angel is a high net worth individual. Seed funds, we're seeing a lot more of seed funds, and really, the definition of a seed fund is really an early stage investor. Generally, a seed fund, though, is where they have other investors come in, they commingle funds, and they approach the market at the very early stage. We've certainly seen a lot of growth in family offices. Generally, a family office is a high net worth family or a couple of high net worth families pooling resources and bringing professional advisors in to do alternative investing. There's been a lot of pop-up of family offices, and really it's like Mike was saying, even before we started, a little of this came out from 08, 09, and 10 timeframe when the market had some challenges. People started doing alternative investments, and now a lot of family offices exist and allocate a certain percentage of their investments to private placements. Strategic investors can mean a lot of things, but in the simplest terms, it's obviously more than financing. They bring market intelligence, they bring distribution, they bring customers to maybe they're in that specific industry, maybe there's a competitive piece of that in there. They also obviously can ultimately lead to assist in exit strategies. So a lot of times we'll look in a more mature round, seeing if we can track strategics into an investment round.
JD, is it fair to talk about strategics as being, kind of they focus on a specific market area or technology?
Absolutely.
And what's the impact of?
Yeah, and I will tell you, Mike, one of the things that we battle with a lot, in particularly maybe in a seed round, is a strategic could be either in a specific technology, a specific industry, and the concern always there is if they're going to come in and invest in you, and there's others out there in the industry, can they limit you from partnering with others throughout that industry? So it's really a decision tree process to make sure that strategic isn't limiting you to being able to expand to other market opportunities or competitors out there. Institutional and venture capital is really, again, it's just a little more sophisticated investor. Venture capital and institutional investors, they have limited partners that invest in them, and those funds then look for opportunities to invest. And in general, that's when you get in more of the Series A and beyond investment. And, they drive usually, a little more difficult terms for the company, but also more structured terms, more governance terms. And, again, they're representing their limited partners in this investment. And therefore, there's just a little bit more, adherence, governance, et cetera, with an institutional investor. Okay, so let's get into some of this. We're going to present 5 rounds of capitalization of a fictitious company. We're going to kind of show how it impacts dilution. I'm going to actually try to go at one point to a live Excel sheet to walk you through some stuff. We'll see if that works. I've got it up on the PowerPoint as well. And then we're going to present a couple of 3 exit scenarios and show the kind of the impact of the capital actually returned to the investors and the founders. So we have 3 founders, Amy, Bill, and Chris. They formed a company called SAS Systems. Each contributes capital and intellectual property to the company, and they've determined each is going to get 200,000 shares of common stock. There's nothing magical about that 200,000 shares. It could be 20,000 shares. It could be 2 shares. It's just that's what they decided to do, is to allocate 200,000 shares of common stock. So therefore, each is going to get a third ownership in the company. They retain a good securities attorney to create the initial organizational documents and issue the stock certificates. And this is a good time, again, to preach the fact that even though they don't have outside investors and they're founding their company, we want everything papered. And they go through the process of papering everything that shows who owns what and all the corporate agreements. This happens to be a C Corp, so they go through the shareholders agreements and get everything documented. And they, subsequent to that point, they understand who owns what and the governing principles of the company. So hopefully you can all see this. This is just the simple cap table set out in Excel showing Amy, Bill, and Chris. They each put 200,000 shares in. So they each were issued 200,000 shares. So there's 600,000 shares outstanding in SAS Systems. If you basically take each of their percentages, that's 33 1/3%. So 200,000 into 600,000, Amy, Bill, and Chris each have a third of the company. And that's where they initially stand after the formation of the company. So they work through product development. and basically decide they need to bring some more resources in to complete development and testing. They also want to start to create some type of marketing campaign to create some awareness. They decide they need to raise $250,000, and they want to really approach friends and family, some associates that they know that have been aware of what they're doing. And again, this is kind of the general evolution of the company, and really kind of, if you will, they begin that endeavor. They put together initial financial forecast and kind of start to meet with friends and family. You know, even though they're an early stage company, they feel their product suite has really a significant opportunity. They established a pre-money on the company of $1 million. So what they've already said is, we think our idea and our development to date is worth $1 million. So we're going to go raise $250,000. They're setting the post-money valuation of $1.25 million on the company. And after multiple meetings and conversations with friends and family, Amy's Uncle Charlie decides to fund the entire amount. So, and again, I apologize if this is a little hard to read, but I'm actually going to open up a live Excel spreadsheet as well. So I challenge you all to get as close as you can to your screen and understand this. But really where we were is the first founders round, where I'm hovering over here, is where they were, there were 600,000 shares outstanding. And basically what they decided to do is set a value of those 600,000 shares down here at $1 million, creating a price per share of $1.67. So if Uncle Charlie is going to invest 250,000 divided into that 167, he's going to get 150,000 shares. Down here in the green is a little bit of the math as well. And I will say that we did not round the $1.67, so it keeps going out to get to an even 150,000 shares. A lot of times you'll see the 167 get rounded, and that changes a little bit of the share calculation. We don't issue fractional shares, but a lot of times the price per share will go out beyond 2 decimals. And I'll walk you through that when I open up my live spreadsheet. But if you move into these green calculations down here, basically what we're saying is the pre-money valuation was $1 million. There were 600,000 shares. So here's how we got to the 167. The amount invested by Uncle Charlie was 250,000, divided into that 167, created 150,000 shares. Over here, we're looking at just kind of a separate analysis, say, well, the pre-money was 1 million. I put 250,000 in, the post-money is 1.25 million. So my 250 into that 125 should give me 20%. So Mike, I am going to try to go, and you tell me, can you see this?
Yeah, it looks good.
Okay.
Maybe you can make it a little bit bigger there with your zoom on the bottom. But
I'm gonna give it a try, not to lose too much. Okay,
great.
Is that better?
That's
okay. This is that same spreadsheet, and again, these greens are just calculations. But what I'm talking about with regard to the ability to run, scenarios is, let's say if all we're going to do, this is the valuation. This is pre-money valuation down here in the green. Let's say that ended up being, they were able to get $2 million out of that pre-money valuation. You're going to watch Uncle Charlie's investment go from 20% to 11%. So, and you're going to see the price per share go from $1.67 to $3.33 and going all the way across. So again, it's a template to show you kind of some, run some scenarios. Also, what if Uncle Charlie said, I'm only going to value the business at 500,000. Now Uncle Charlie's getting 33%, and you're getting diluted. You guys are getting diluted from 33%, the founders, to 22%. And again, the calculations down here all run too. So if I go back to my 1 million, this is where we were, right? Uncle Charlie got 20%. But what if we wanted to raise 500,000 from Uncle Charlie and another investor? Let's see what that impact would have been. Well, we're almost back to that same calculation where we're diluted, but now we have 500,000. So again, it's as simple as setting up the math to allow you to run those scenarios, run basically the analysis of pre-money, how much you're going to raise, and what the dilution impact is on you. The other piece of it is again, looking at how much money you're going to raise. And somebody asked about oversubscription. Well, one of the issues is they only thought they needed 250, but somebody wanted to put another 250 in. At this point, is it worth that? If they really think they only need 250, they're going to go get market traction, they're going to create awareness, and then they're going to go raise some more money, but at a higher stepped up valuation. This is the ability to kind of allow you to run through those scenarios. Mike, I'm going to stop and see if anybody has any questions on the math.
So it's not a math question, but so the pre-money valuation, is that just purely based on what you can convince your investors that you're worth?
That's a great question. It always comes up too. You know, we actually do a lot of valuation work, and you know, valuations on mature businesses are based upon, you know, cash flows of the business, discounted cash flows, market trends, et cetera. I actually did a presentation with Mike for the Angel Capital Association when they came here in the Best of the Midwest or whatever it was, about early stage companies and pre-money valuation. And that answer is it's a lot more art than science. It's you're trying to convey the market opportunity, the exit opportunities, and really trying to convince those investors that you're worth what you are today. I will tell you, as we get going through this process, a lot of times when you get to the seed rounds and the A rounds, that pre-money is set by those investors, and it's always a negotiable term. We've had early stage companies, pre-revenue companies, come to us to want to do a valuation so they can go hand out to their investors saying, here's what we're worth today. It's so subjective and it's very negotiable. And the best advice is listen to the market, listen to what they're telling you, listen to the investors. Again, we've had a lot of people, you know, come through us and say, well, we're worth $20 million today. This idea is worth $20 million. And, you know, in the end, they hear market feedback that they're not worth $20 million. So investors will say, you could be worth $20 million, but you need my $500,000 today to get to be worth $20 million. So pre-money is very subjective, particularly in early stage.
And I think I'd add, just, you know, investors, when they look at these, we're not really looking at, is it worth 1.2 or 1.7 or whatever. We're trying to figure out, you know, what's the best deal we can get for our money to get into a company we really want to be part of because we think it's going to grow. Or this is not a Wall Street investment or a fund investment. We're taking a big risk for a big reward. And so we're going to make, in a lot of cases, 10 or 20 or 30 bets like this, hoping half of them do okay and a few do really well, because we know some of them aren't going to make it. That's just part of the deal. JD, I had a question for you myself. Are you okay with sharing the spreadsheet template with people afterwards?
Yeah, I am. And the big caveat on that, Mike, is this simply is just an illustrative example, right? You know, so each is different. I do want to show you even the fact that there's a lot of ways to do this, but if I go down to my 167, you'll see my calculation to get to the 150,000 shares. I'm taking that 167. I'm going to go the other way out, right? I'm not rounding it. If I rounded it to $1.67, it'd be 149,000 something. And a lot of times it's a little different. We never do fractional shares, but there's a lot of different ways it can be done as long as it's just disclosed. But that's how I'm doing it, to be able to actually show the 250 with an even 20%. So that is not a rounded number. That's the only thing. But yes, we can certainly share this, just under the premise that, you know, each scenario is different and you know, each calculation is different. I'm trying to think of any of the other kind of math scenarios, but again, I'm going to repeat this. Go ahead.
Oh, we've got another question in the chat. Yeah. If you want to take a look at it, have you got it open there?
I do not, Mike.
Read. Okay,
I've got Excel open.
Yeah, no problem. So if you've set a pre-money valuation, raised some of it, are thinking of closing it early, but then a strategic investor is interested and wants to oversubscribe, do you close the first round and then do a new valuation based on their strategic partnership?
Yeah, we've actually seen that happen, and I will say this: it kind of depends on that institutional investor, because a lot of times they don't want others within their round and their preferences, and they may want a different type of security. Generally, if you can keep it, we try to avoid short period financing events, but they can be done. They certainly can be done, and we've seen it happen. we've seen rounds opened as well, where again, it's an extension of the round, like you all of a sudden have a A+ round or something like that, or an A1 round. It really depends a lot of times on whoever that institutional investor is and what they're driving. I will say this as well. Always make sure you have a good securities attorney to advise you, because whatever that initial round and whatever those initial documents said might dictate what you can and cannot do there. So we've seen scenarios on both sides where the institutional investor will come in and then drag all the other investors that came in and give them better rights because they wanted to allow them in. Or we've seen it where the institutional investor says, close that round. We don't want all these individuals and high net worth individuals to get our preferred rights. So it really is, it can happen, and it can happen in both ways, but it's really making sure whatever your initial investors came in on, you can only offer them better terms. And if there's a step up in valuation or something like that with the institutional investor, or if there's a decline or the institutional investor is getting better terms while you're still raising money from the others, then you have some challenges. So, but it can certainly happen. But, you know, I'm not an attorney. And I will say, this is a good opportunity to say this as well. When I initially meet with potential clients, one of the top 3 questions I ask is who is their securities attorney? Because it's very, very important that they're getting good advice and the documentation is there.
I'm going to add to that one more thing. There are a lot of kinds of attorneys out there, just like there are a lot of kinds of doctors. And you want a specialist. You want to find, and there are many in the Des Moines area, there are many in Iowa, there are many across the United States. You want to make sure that the person doing your documents has done this many times before. People complain about being really expensive, varies money. Actually, it's not if you get a good securities attorney who's done it many times, because they're going to use standardized forms from National Venture Capital Association. They're going to understand the terms in the marketplace. And frankly, you'll probably end up spending a lot less money for a very experienced securities lawyer down the road than you will if somebody that, you know, has only done it once or twice, does your paperwork, and 2 rounds later, a VC says, I can't sign this because this deal, the paper on this deal is weird and different, and I've never seen anything like it, so I'm going to walk away. And that happened.
Yeah, Mike is spot on. I mean, when I get concerned is when I'm actually explaining, you know, the financing round to an attorney, and kind of even terms or what a convertible note is, or all of that. You know you've got challenges.
That's scary. We got another question here. How often do these early stage investment deals straight up equity versus convertible notes that convert to equity at a later date?
Yeah, that's a great question. We're not going to show a convertible note or a safe note as we go through this, but let's just say under this scenario that they didn't want to price it today, and they convinced Uncle Charlie to, hey, come on board with this, Uncle Charlie, and we'll convert you into the next round. A lot of times that's done from a perspective as we don't want to set value today. We want to get the money in, or we want to bridge, you know, Uncle Charlie, we're going to go do a seed round, a significant seed round in, 9 to 12 months. We'd like to have you come in on a convertible note into that round, and we'll give you a discount into that round. We're seeing a lot more safe notes. I'm not going to get into the details of that. Hopefully, maybe Joe or BrownWinick will talk about that when they do the term sheet. But really what that is, it's a right to convert and price the round later. Generally, there's a discount. 20% discount is kind of standard. We've seen it 25, we've seen it 15%, where it's really, hey, you invest today with me, and we're going to give you a discount, whatever that price round is. The other thing, we're going to get a little technical here, is but most notes have a cap on them as well, saying, okay, I'll come into that next round at that discount, but you can't let the valuation get above certain levels. And so most convertible notes have, what's called a valuation cap on it as well. So they really, the investor knows, hey, at the top, this is at least what I know I can convert into at that discount. So we see it a lot. I mean, we definitely see it a lot. We actually see it even in later rounds where we're just going to do a bridge. We're saying, hey, we need to get $1 million in. We're going to go raise $5 million next year. We just going to, get a little more fuel in the tank, and we're going to bring that in, and we're going to give you a discount into the round. So it's a very common instrument.
Yeah, in fact, a couple of my investments have had that situation where someone they had a short-term cash crunch, revenue didn't come in when they thought it was going to come in. They go back to their existing investors with a note. And in one case recently, I got a check, said, here's your money back. It was, they didn't convert. They just paid the money back. And for me as an investor, when I see something like that, I mean, they had the right things were going. And all it is saying, let's not go dilute the cap table. Let the entrepreneur basically borrow some money on a note for the existing investors, keep our valuations where they are. With high confidence, obviously we had very high confidence it would work out, and it did. So they're very common to use as an investor. I've become comfortable with them. The key, and we will, as an advertisement for next Thursday, we will talk a lot about convertible notes next Thursday.
Yeah, and to your point, Mike, I mean, generally a convertible note is structured where a triggered conversion is based upon a qualified financing, meaning if we go raise $2 million, it triggers your conversion. If we decide not to, we have the option to pay you back or however that's structured. And to Mike's point, some convertible notes, they end up not moving towards the qualified financing and they pay it back. Convertible notes generally all have interest. Generally that interest is accrued and converted at the same time of the qualified financing, but we certainly see notes get paid back as well.
We have another question. I love the questions. Thank you.
Yeah.
Keep them coming. What is the typical approach to issuing shares as having voting rights versus no voting rights? I assume this is possible.
You assume what, Mike?
She says, I assume that this is a possibility, or this is possible.
Oh, yeah. Generally, anytime you bring an investor in, they generally are going to have voting rights with you. Sometimes early stage, when founders are forming a company, whether it be an LLC or a C Corp, and they're giving, founder shares or, advisor shares or something like that. Sometimes they demarc between voting and non-voting. Sometimes family-owned businesses demarc between voting and non-voting. It does impact valuation with regard to non-voting shares. And, again, I'm not an attorney, and generally we see all rights be basically pari passu, where whoever's coming into the round generally do have voting rights. But we've certainly seen it where there's class of units and class of stock where there are voting and non-voting rights. Voting rights generally are valued at a lesser amount than, non-voting rights are generally valued at a lesser amount. I'm going to flip back to the PowerPoint here, hopefully. We back?
Look.
Can you see it, Mike? Okay. Okay, so again, to kind of move along again, if we're going to recap again, the Uncle Charlie put $250 in, he has 20% of the company. The founders have now got $250 into the company. They went from 33 1/3 to 26.67, almost 27% each, but they've got a little fuel in the tank to move forward. So they keep kind of plugging along. They identify a key hire they want to bring on, and they talk with her, and they discover she's not really interested in joining the company without some type of equity incentive. They meet with their attorney and they say, okay, we're going to establish an option plan for you. And they decide to allocate 10% ownership as of today to create an option plan and an option pool. So what that really means is basically they've carved out 10% of the company now for future hires, including this individual, to be able to give them some incentive for the upside in the company. And what we've done here now is we've moved from Uncle Charlie's investment at the same time and created an option pool here where we're rounding up to get to 85,000 even shares, so about 10.18% of the company. And we've created a pool of, if you will, future ownership opportunities. And all an option pool is the option to be able to buy stock or units at today's current market price. Sometimes, if you will, options get issued each year at a different market price. So as the company continues to grow, they bring hires in and all of this. We're going to go through the scenario today as we move through this, that we're going to assume all these options are are eventually getting issued to all key employees at the same $1.67 that Uncle Charlie came in at. But as you can see, you know, if all of these eventually get issued and exercised, there's a dilutive impact on the investors, because these guys were all, Uncle Charlie, you know, was diluted during that process as well, but the other founders were diluted as well. So we now have 835,000 potential shares. And what that is it's called a fully dilutive analysis. I mean, in other words, these shares, these options haven't necessarily all been issued yet, but the future opportunity is they could be issued and they could become shareholders.
JD, do you want to talk about what happens when the investor that's investing in your round says, great, I want to invest, but you're going to do your option pool before I invest?
Yeah. I mean, that's what we see a lot of times is to that point is, particularly, and you move into the institutional investors, they'll ask you to issue that pool before they invest and price that pool into their round, so it doesn't dilute them. And a lot of times you'll see that. In this scenario, we're diluting Uncle Charlie because the options kind of came in after Charlie's investment. And that happens a lot of times in friends and family rounds, is as they mature, well, we got Charlie's money and now we need to get a pool. Sorry, Uncle Charlie, we're gonna dilute you a little bit here, but we're all getting diluted as well. A lot of times, to Mike's point, is a more sophisticated investor is, hey, let's get the pool. You price that in. So Uncle Charlie's investment, this $85,000 shares would have already been priced into over here in the 600,000 would have been 685, and the price per share would have been a little less, and the institutional investor would have gotten more shares. Again, trying to keep you can go through so many rabbit holes on a cap table. We're trying to keep it somewhat at a high level, but really to kind of show you kind of the maturation of a cap table. And again, I'm going to continue to repeat, all of this needed to be papered. You know, it's very easy to take Uncle Charlie's money and say, yeah, we're gonna have our attorney do it next month or the following month. You got to paper everything, and obviously, particularly the option plan as well. So now, on a fully dilutive basis, we have 835,000 shares outstanding. Obviously, in a typical company, you know, not everything works perfect. They had some technical issues with the platform, and you know they've made significant progress, but they're slowly running out of money with the cash burn. They have a staff of 5 now. They decide they really need to go raise a seed round of financing. They kind of analyze everything. They want to keep it, you know, they don't want it to be a huge dilutive impact, so they decide to raise 500,000. You know, after meeting with several investors, Plains Angels Group decides to invest 500,000. They negotiate a pre-money valuation of $2.5 million, which is a nice step up, and a post money of $3 million. So I apologize that this is going to get a little small, but I do want to kind of walk you through this. So basically what we're saying is we're going to focus over here where we were, right? Here's the 835,000 shares, and here's, you know, everybody after we've done the round with Charlie and the options. We're going to set a $2.5 million valuation on the company, and if you remember, we have 835,000. So basically, we're setting a price of $2.99. So Plains Angels are going to invest 500,000 at $2.99 and get 167,000 shares, or just under 17% of the company. So the founders now go from their original 33% down to just under 20%, but they brought in $750,000 already and have issued an option pool.
And in that, JD, I was just going to say, in that case, when people are like, well, I got diluted. Well, your original shares were worth, what, $1.67 or whatever, and now they're worth $3. So did you get diluted? So you have to look at the money, not just the percentage.
That's right. And, you know, and they've got $750,000 of capital to kind of continue to create that valuation. Well, I walk a lot of founders through that exact example, Mike. You know, they're always worried about dilution, but the fact is that, you know, if you didn't get the 500,000 in from Plains Angels, you're going to close your doors. So you could have your 23 or 24% of zero, or you can get, you know, 20% of a viable company again. So, and again, that's a lot of times when the pre-money conversations come in. Okay, so now after that, we have just under or just over 1 million shares outstanding in the company because Plains Angels got 167,000 shares. And the important thing I get asked sometimes a lot, and we didn't get asked it, but I'm just going to make sure I state it. These new shares are all issued from the corporation. You know, Amy, Bill, and Chris aren't selling their shares and everything else. It's generally the corporations authorize so many shares to be issued, and these are new shares getting issued, and then obviously the compounding dilutive effect. But it's not like, you know, if you look across, Amy, Bill, and Chris all still have their same amount of shares.
So do you get, I guess, if Charlie doesn't know what's going on here, he might keep getting surprised that he keeps having a smaller and smaller part of the company. Is that an ongoing issue?
Well, you know, that's part of the documentation and the explanation, and that's, you know, that is a challenge, particularly in friends and family rounds. As you move up the food chain with regard to investors, they truly understand dilution. But that's something that generally is documented in all the corporate documents. I've come into situations where, you know, somebody will come in and say, well, you know, the initial guy, he put 100 grand in at 10%, he can never be diluted. Well, let's go repaper that, because that's just not the case. So dilution is an inevitability in financing of a company, and generally, Uncle Charlie would have probably read those terms. But it is a discussion we have a lot of times with early stage investors. I will say this as well, to your question, what we're showing here is a very high level of like Uncle Charlie put the full 250 in and Plains Angels put the full 500 in. A lot of times that could be an aggregation of, multiple investors. And then you'd have a subledger of all these investors, but just show a high level of like, Plains Angels could have been 15, 20 people. And so it's very important that you kind of understand how to kind of manage that process as well. Generally, because of your question and a lot of other questions we get, we try to say, okay, we're going to raise 500,000, but the minimum investment has to be 50 or 100,000. We always want to keep the cap table as clean as we can. And a lot of times what happens as well is like Plains Angels could be 15 people, but they'll form a single purpose LLC to come in and really just have one shareholder. And we're seeing a lot of that happen too, because therefore they're not having to deal with 20 other people calling them all the time and asking questions all the time, et cetera. But, again, we're trying to keep this at a very high level, but even the friends and family could have been, 4 family members that would have come in at that and all had that. And each family member or each Plains Angels or each individual creates further challenges with regard to communications, shareholder expectations, et cetera. So we always try to keep what we call as clean a cap table as we can. The best way to do that is to set a minimum amount that is required for an investment to come in. So we don't want to take $5,000 or $10,000 investments. But generally, all of that dilution and everything else is documented in the investment agreements.
And Tony, I would add that if you do the math on that, Charlie's 150,000 shares at basically $3 a share is now worth 450K at the current valuation. Yeah. And when he put it in, it was worth 250. Yeah. The other thing that we aren't touching on here too much today, and maybe we'll talk about it, I don't know if we're going to do it or not, JD, but is pro rata rights. So when I'm investing in a company, I really want pro rata rights. And all that means is that in future rounds, I can invest alongside and maintain my proportion. So, I'm Charlie, I put my 250 in. If I had pro rata rights, I could have come into the next round, added more money, and maintained my percentage. Now, I may or may not want to do that, but it's a right sometimes investors, frequently they'll ask for, especially early stage, because the company's going to need more money. I've rarely ever seen a company say, I think I know of one in Iowa that raised their money and hit it so well that they just like, yeah, we don't need any more money. That's a wonderful thing, but it almost never happens.
Right. And we're not going to get too much into pro rata rights. We're going to talk about it a little bit in the down round, but we're not employing it, Mike. So that's a great point. Okay, Mike, you mentioned a break at one point. Do we break now or do we go through Series A and then break? How do you want to do it?
Let's break now. I've got 23 after the hour on my clock. You want to come back at 35 after? Give people about 12 minutes.
35 after. Okay, and then just so everybody comes back, what we're going to do is we're going to go through a Series A, we're going to go through a down round, and then we're going to go through the liquidation of the company under 3 sell scenarios based upon all of what we've built up. So we're going to kind of get you to a crescendo and kind of walk you through everything. So all right, we're going to kind of continue. We've kind of created the foundation of how the math works. So just to recap, after Plains Angels came in for their 167,000 shares, there's now 1,002,000 outstanding after that seed round. So they moved forward with product development. The beta was successful. They released a product, and with 18 months, have an annualized recurring revenues in excess of $1 million. So things are going good. They need substantial capital scale, and they now have a staff of 14. So they hire an advisor and launch what they're determining as a Series A. And after multiple meetings, 4 months, which is probably somewhat quick, the pitches and meetings with VC firms, they receive a term sheet. Now this time is a situation where now terms are being set for them, but they've had $1 million recurring revenues. They believe there's a market opportunity, and obviously the VCs do as well, and they basically get a $2.5 million preferred stock offering with 10% non-compounding dividends, basically just 10% annual dividends. And we're able to get a very, very nice step up in valuation of $7.5 million. The VC Ventures who stepped in did request a liquidation preference of 1x. All that means is VC Ventures gets their money out before anybody else gets their money out. And we're going to kind of find as we go that sometimes matters. And then there's some certain governance restrictions, board seats, maybe, before you can, borrow money, they have, approval rights, maybe it's CEO salaries, et cetera. But anyway, there's just some governance restrictions that you'll get into when you start to talk about the term sheet. So we've condensed this a little bit and got rid of kind of some of the initial rounds, but what I want to basically show you again is here's the 1,002,000 that shares were outstanding. We set they set the pre-money at 7.5 million right here. Whoops, sorry. 7.5 into 1,002,000 is $7.49 a share. To Mike's point earlier, shares are continuing to increase in value. VC Ventures for that gets basically 2.5 into that 749 or 334,000 shares, and basically kind of that same math, right? We had a $7.5 million pre, we have a $10 million post. VC Ventures now owns 25% of the company. As you'll see though, I mean, basically, sorry, that keeps doing that. They've now raised over $3 million, and the founders still are each just under 15% with over $3 million of capital raised.
So is there a concern when the founder's percentage gets below a certain level where they no longer have control over the company?
Well, in a general company such as this, when you're continuing to finance it, it is a trend that happens. Under this scenario, this isn't a lifestyle business. This is somebody's, scaling, bringing on investors, and really ultimately looking for either that exit or that strategic partner to either, merge with them. So generally the answer is no, because it's kind of the expectation of what they're doing when they're bringing on this substantial amount of capital. By a lifestyle business, I mean, it's somebody that's owning a business that really doesn't want to bring outside investors and wants to maintain control. But, again, the issue being is they each own almost 15% of the company, and others have put over $3 million into the business to continue to grow it. So it's kind of that natural evolution.
Tony, to be quite honest, what I see a lot of is people, as a mentor, people getting so concerned about that percentage, they fail to grow. So, I mean, you're not going to build a company like Google, Facebook, whatever, without raising just a ton of money. And so, I always try to tell people, look, do you want 100% of your company or 1% of Google? You've got to really look at, again, do the math and say, well, those 200,000 shares for each one of those people are now worth 1.5, JD. I'm roughing out the math in my head, $1.5 million each. So not a bad little exit if they were to leave the company right now, having spent 3 or 4 years doing it, getting paid and building something pretty cool. Now, obviously they want it to grow a lot more and get a much bigger multiple, but I mean, it's you have to look at it in context to the growth, as JD said, the other money in the business, the other people in the business. Any one of these founders could not have done this by themselves.
And to the point Mike brought up earlier, a lot of times, Charlie or Plains Angels would have had pro rata rights to invest along. We're for purposes of showing the liquidation on all of this, we're not showing that they put additional money in as well. But Uncle Charlie could have, but it would have been at that same valuation. They would have had to buy in at $7.49 a share as well. And we're not showing that, but a lot of times you'll see that, and that will be discussed, I think, in a future module. But so VC Ventures now owns 25%, and there's over 1.3 million shares now outstanding in the company. So basically, they get initial traction, but it just didn't lead to nationwide market acceptance. They're starting to go through a lot of cash. Many of larger companies have moved downstream and have developed comparable technology products that can be deployed much faster with the larger corporations' resources. They're getting squeezed on pricing, and they hadn't anticipated that. And their margins began to erode. They needed more capital to position the company for vertical product growth, and at this point, ultimately maybe seek an exit of the company. So again, they negotiated with VC Ventures, and again, this could have been another investor, but we're going to make it somewhat simple here to show that basically VC Ventures, who funded the Series A, to fund the company through product suite enhancements, and then VC Ventures was going to then hopefully assist them in seeking an exit with an industry competitor. So basically, the post-money valuation after VC Ventures came in was $10 million. They negotiated a pre-money on this round of $5 million. So the company went from a $10 million valuation to $5 million valuation. Again, for lack of a better term, VC Ventures is doubling down. They obviously believe there's still an exit for this company. They believe that $2 million can yield a great return for them at that $5 million valuation. I assume at this point they're probably having a lot more governance over the company. And they could have come in at a lot harsher terms, but they're going to basically come in at the same terms. Sometimes you see terms, and you're going to get into it again, where it's more punitive on the founders, or it's more punitive on even all existing investors, and they just completely kind of wash them all out. So they're coming in at the same terms, which is 1x liquidation and the 10% dividend. And they agree to fund another $2 million. So VC Ventures is now going to have $4.5 million into SaaS systems. We've consolidated this a little bit again, just kind of basically show a few things. We showed the founders and the Series A and the recap, but as you'll see over here in the recap now, we had 1.336 shares. We now priced it at $5 million. So the share price went down from $7.49 to $3.74. Well, VC Ventures came in with their $2 million here and now have 28%, a little over 28.5% of the company on this round, combined about 46%. They did dilute themselves a little bit on that prior investment, but that's them doubling down to now own approximately 46% of the company and have $4.5 million into it. And to Mike's point, I mean, this was more market traction. Maybe the market got ahead of them a little bit. There's a lot of reasons for down rounds. We've seen them very, very punitive. We've seen a lot of reasons. It could have been that they got ahead of their valuation initially and kind of ran up, but things were still really good, but they still needed to have a down round to go get the substantial capital they needed. So now we have basically 1.87 shares, 1.87 million shares outstanding. and the company now has raised substantial capital. So I'm going to run through 3 sales scenarios, and then obviously, don't hesitate to ask questions as we go through this. But basically, went through product refinements, customer growth, great things happened, and they received an offer to sell for $17.5 million. All the employee options, and again, the assumption is that they've all been issued an exercise. Again, they're all at that initial $1.67. There could have been more options added through the maturation of the company at different prices and all of that, but those 85,000 options we're assuming for this exercise are all priced at $1.67. So the $17.5 million is going to allow a payday for the options as well. The close came, approximately 1 year after the down round and 2 years after that Series A, resulting in that 10% accrued interest on that 2.5 and then the 4, or the other 2, of about $700,000 due to VC Ventures. So that's money they get on the top before any proceeds go out to any shareholders. Again, I'm going to apologize for this being small, but it's just kind of hard virtually to do these things. But let's walk through at face value what we think is going to happen to that $17.5 million. We're over here. So after that down round, the founders still had a little bit above 10%. So the assumption being that they're going to get basically their pro rata of all of this, of that $17.5 million. Well, they almost do. On this round, there's enough money in that VC Ventures terms don't necessarily kick in with regard to the fact, again, they have a liquidation preference where they either get their money back or they prorate and take advantage of the price per share that's being paid. This time, the price per share is above what their initial investment was. So VC Ventures is going to get $700,000 in the dividend, plus participate in the liquidation of the $17.5 million. Under this scenario, we're showing the options are all getting exercised. Those 85,000 options are getting exercised at that $1.67, which is then yielding the key employees almost $770,000. In theory, that could be netted, and a lot of times that isn't netted. So that check isn't written, but this number's net of that number. Doesn't affect the proceeds, but I'm just showing you for this purposes that the $17.5 million plus the option proceeds gives $17.6 for distribution, preferred dividends of $700,000, and then the rest of everybody, participates pro-ratally. So VC Ventures, while they own about 46% of the company, get about 48% of the proceeds, which isn't, it's a great exit for everyone involved. Okay, I'm going to keep moving. All right, scenario 2. This time they didn't really get the traction they wanted, but they did still have the opportunity to sell the business. They received an offer for $8 million. All the employee options have been issued and exercised again, and again, the same assumption with regard to the timing of the offer being where there's accrued dividends about $700,000. But this time, the liquidation preferences that VC Ventures had, remember, VC Ventures put in $4.5 million. They have the right to get that 4.5 plus their 700,000, or participate basically in the distributions on the price per share basis. So under this scenario, it's an $8 million. We're still showing the options getting exercised, but this time the options get very skinny. You see, they're going to write a check for $141 and only net $249. And again, we could show this as a net figure, but I'm just showing it for illustrative purposes. That it's really, they're still getting a little money, but it's, not that significant of an amount. But this time VC Ventures is going to get their 700, but instead of participating pro-ratally, they're going to take their 4.5 off the top because they have a 1x liquidation preference. So they're going to get their money back plus the 700,000. So they're going to get 5.2 of that 8 million or that 8.1. So this time on a lesser offer, while they still only own about 46% of the company, VC Ventures is getting almost 64% of the liquidation proceeds. So again, you're going to get into term sheets, but this is a common occurrence, right? The valuation just really didn't get to the level it needed to get. You sit over here and think, well, heck, I own almost 11% of the company, $8 million. That's going to be a great payday for me. Well, it's still, the founders still did okay. Plains Angels put 500 in and they got 490 back. They scratched out. Uncle Charlie still did okay, and the founders, not too bad. And the key employees got a little bit of crumbs from it. But, again, VC Ventures, who doubled down, got 64% of those proceeds.
That's a great advertisement for why you want to come to our class next.
Yeah. And the next one's going to even be even better. So the same scenario, let's go through one more scenario. And this time, let's just say it's 8 million again, but what if the terms for VC Ventures were just a little different? What if there was just one more term put in the original term sheet of both investments, and that term is participating? And they had a preferred stock with 1x liquidation, but if it's participating preferred, what that means is they get their 4.5 million plus their 700, but then they participate pro-ratally in the rest of the proceeds that are left. One word. And it can significantly impact the waterfall of this distribution. So again, here's the 8 million. This time, the proceeds for the key and the options are out of the money, and we can walk you through how that gets proven. But the point is, there's no money for them, so they're not going to necessarily exercise the 141 to get zero. So this time, there's $8 million in there, and here's why: because VC Ventures are going to get their 700. VC Ventures is going to get their 4.5, but now they're going to participate on the remaining funds based upon their pro rata percentage of 46%, and get 1.3 additional money, at 1.3 million in additional money, because it's a participating preferred. So this time, the $8 million that's getting paid out, ownership hasn't changed over here, terms changed. VC Ventures is getting 82%, or $6.5 million of that $8 million, basically because there was one word in a term sheet that allowed them to participate pro-ratally after they got their 1x liquidation preference. And again, the point is, we're actually doing this for a client right now that's in their actually Series F. We're doing a significant waterfall, and terms matter, preferences matter. You can look and say you own X% of the company, but if someone else came in a different series, a different class, a different rights, different preferences, it really does matter how you look at a deal. And again, we do a lot of sell side deals where we're working with shareholders, walking them through kind of what the waterfall looks like. And a lot of times it's kind of the initial shock to say, well, I didn't realize this, I didn't realize that. And so again, the cap table is very, very important to keep as a structure of who owns what of your company, but it doesn't always dictate who gets what from a liquidation.
So sorry.
Go ahead.
So the early stage investors like Uncle Charlie, they don't really have any control over their destiny here, right? If the owners make some bad choices on terms, they get screwed.
Yeah. And what we didn't show is generally, sometimes institutional investors don't allow Uncle Charlie to come along, but there sometimes are opportunities in the initial documents for Charlie to be able to participate pro-ratally. He would have had to invest more. Again, we kind of gone so many rabbit holes, and there's so much complexity into it. But in general, yes. In general, early investors sometimes don't have the rights and the preferences that the later stage institutional investors have. And again, particularly the founders, right? And we could have, we did one 3 years ago where the founder actually got punished. The founder had to earn his shares back. And that was part of the negotiation of the VC coming back. So, again, everything's negotiable to some degree, and it was really restrictive on the founder itself because they wanted, them to prove execution. And they actually stripped some shares because that was part of the negotiation. If they wouldn't have written, the check, they didn't have the rights to do it. But as part of the negotiation, saying, hey, we're going to put so much money in, we want you to earn your ownership back. So there's a lot of things that could get structured in this, but yeah, generally to answer your question, the more sophisticated investors are generally going to drive stricter terms. And, again, this exercise is really to show and create the awareness that it's not just who owns, but what terms they come in on, and so there's so many different ways we could look at it.
Is that because they've just seen more deals, so they know how they could sway it toward helping themselves out a little bit more?
Yeah, and I'll answer it this way too. I mean, most of the time, and again, a venture capital fund, they have investors, right? They have protocols. They have what's called limited partners. So any venture capital fund, it isn't just the owners of the venture capital fund that are investing their money. They usually have, banks, pension plans, school districts, insurance companies that are investing in them to manage those monies. So they have to basically have a fiduciary responsibility to drive a return. It's, sophisticated and definitely, experienced, but they come into it already with a predetermined structure of how they will invest. And, that's just, a general occurrence.
So as a founder, how do you balance, or how do you recommend to founders to balance? This is the question I put in the chat, but if you should or shouldn't give those preferred or extra rights, and how do you navigate that with the potential investor to make sure that they know that you still really appreciate them and are excited about the opportunity to work with them, but you need to protect yourself. So how do you navigate that in an efficient way?
Yeah, it's a great question, Lana, and it's difficult because I will say this. I mean, to that point, you always want to, initially try to fund it through friends and family, seed as much as you can. But if you want to put gas in the company, a lot of times it is bringing in that institutional investor. And I will tell you this: we have negotiated some terms away. We have drug along other shareholders to get the same rights sometimes. But a lot of times it's their charter of how they invest. And so part of what we do is prepare our clients for the understanding of just what happened here. There's a lot of other stuff we didn't talk about. You're going to talk about in the term sheet, just even with regard to governance. They might throttle your salary. They might take you to a situation where you're going to earn, basically a salary or bonuses based upon the performance of the company. There's a lot of other things than just actually the liquidation of it. It's the actual governance, it's the decision making of the company as well. And generally, if you're going to move up the food chain with those types of investors, they're going to dictate that terms. Otherwise, they can't invest. And so it's more of awareness, Lana. And a lot of times it's the trade-off. As long as you can negotiate valuation where you're comfortable and you really believe you ultimately have a great exit opportunity, it's analyzing all of it.
To JD's point, I think part of the lesson here, I guess I would say most of the lesson here, is you want to do these scenarios before you sign a deal. So before you sign a term sheet, before you agree to a deal and close, you want to run these scenarios. You want to have 3 or 4 scenarios in your mind, and some of them are bad, because bad stuff happens, right? And it happens to most companies. Most companies hit a down time. Very few just go up with a nice slope. So I think that's the real key here, is that it's not just, hey, they're going to give us our $2 million. We need to keep going. It's okay. They're offering us $2 million. What do we do? What does it mean to us? And then the second thing I'd add to this is, you want to be looking for multiple investors, and you want to get multiple term sheet offers, because then you and your advisor, like AJD, have the power or the leverage to negotiate. If you've only got one investor at the table, you have very little.
Yeah, that's right. That's exactly right. We just did a deal with a client that, with a venture capital firm, that the structure was a 5x return, and what it was a debt instrument where after 30 months they're going to start to pay 5% of the proceeds back on the note, or convert them, and we created a cap on the conversion. But my client was so convinced they're going to continue to grow that they're going to determine that they're going to pay 5x back at beginning after 30 months and not have them come on the cap table. And their whole push on that was they didn't want the terms. They don't want them to come on the cap table. They wanted the money. They're early stage. And so it was really revenue-based financing is what it was. So there's a lot of creative terms out there that, you can come up with that you're going to pay more back in a note on the backside, but not have them on the cap table when you ultimately take an exit. We've seen a lot of creative structures lately. But, again, just to recap, it's really important to understand your term sheet, and really important to understand the investment documents as well. And there's a lot of different ways you can structure a cap table. And what I showed you at the end of the day is really a math exercise to some degree of saying how you price your company based upon pre-money valuation. How many shares do you have currently outstanding? That's your price per share or price per unit. And what we do a lot of times is we'll run scenarios with our clients, and they'll say, well, I got to have a $10 million valuation, or I got to have this. And you take them through the scenario and say, what if you get this money at a 6, it's only 4% less dilution on you or whatever, but you got the money, let's go type of thing. And you kind of walk them through it. Everybody kind of always focuses on, I gotta have this huge valuation. But there are trade-offs, and you can get ahead of yourself on valuation as well. I don't know if there's any other questions, Mike. Just a couple of we always keep it current. You just can't stress again how important it is to have everything documented. It's if you do anything, do that. Again, it shows the summary of ownership, not necessarily liquidation rights or percentages. And then always make sure you understand the terms when you're bringing investors.
Yeah, I'll add to that I've been involved in deals where the documents weren't up to date, and the round gets canceled because the investors just walk away. It's like, look, and it's a bad mark on you. If you're not as a founder, if you're not keeping this stuff up to date, we're assuming that you are not the best manager. And the next question you ask yourself is, how am I supposed to do all this myself? Well, yeah. And it's not an advertisement for people for JD specifically, but it's an advertisement for people like JD and the lawyers out there that do this for a living. Is they do it for you. A lot of this they do for you, because you shouldn't be spending all your time doing this. If you spend all your time doing this, you're not out selling your product, you're not out running your company. So part of raising money and going through this process is to make sure that you not only have enough to run the business, but you have enough to have these advisors with you. And it's not a huge amount of money. But that's part of how you answer all these questions, is you get smart people around who see things in a term sheet or notice things in a cap table that sometimes are to your advantage that you didn't realize. So I just can't stress that enough. And the reason I say it is I've seen too many people lose so much of their company because they simply didn't read the term sheet.
That's right. I don't know if there's any questions in the chat or on the video. And again,
mostly
we kept this at a very, very high level. There's so many different ways we could have looked at this, and I will tell you, calculating even pro rata rights it's complicated, right? To say you got to put this amount in to keep your exact ownership and all of that, and but it's doable, and we do it all the time. And then down round scenarios, exit scenarios, they're all a little bit different. But we tried to keep it somewhat at a high level and keep it kind of at some basic terms.
Any other questions from anybody in the audience?
I'd be kind of curious to hear from just people in the audience what stage your company's in, even if you just throw it in the chat. And sometimes I think that can help feed additional questions, potentially.
Good idea.
If you feel comfortable.
Yeah. I definitely encourage everybody to participate in the term sheet module.
I don't know we answered this one. It's, is it common for investors to ask for option pool expansions before each round?
We've certainly seen it, particularly institutional investors. If they, again, the whole purpose of them asking for that is they want key employees incentivized, and they want that issued and that pool established so it doesn't dilute them post their investment. So we've certainly seen it where they're, let's even say, VC Ventures was going to come back in on that down round, and they wanted to bring in a key executive to kind of help them, because they weren't, pleased with the management team. they might have made them, carve out an additional 5% options before they would invest, which would further dilute everybody else other than them. And so we certainly have seen it, not always, but it's the whole driver on that is generally is they want to have an incentive management team to go drive creation of value.
The other thing about options is it's a retention device when things go poorly. I was with a company that had a horrible run in the stock. We were actually in the stock market, and they had a really bad time for a couple of years. And I mean, the stock went down, I don't know, 80% down. And I can tell you as a key employee in that company, the fact that I had a bunch of options and that they, as things got really bad, they issued a whole bunch of new options at that much lower price. It incentivized me to stay there and work hard and help turn the company around, which thankfully we did, and it paid off very well. But just keep in mind that they are one heck of a great tool to keep your team together during really bad times. It's one of the reasons you want to have that option pool ready to go and a team of investors that are on board with you, because you need those people.
That's right. We've actually seen too where there's the ability to not issue new, but reprice old, right? Options and stuff like that. There's ways to actually do that too. So it's bringing them back into the money as well. But again, the whole driver on that is, like you just said, Mike, is to keep you incentivized to help them get their ultimate exit they want to get.
And I think you've got to keep yourself in the current and future. You can't look back and say, oh, my stock was worth $10 million. Now it's worth $2 million. I mean, don't get lost in that. Your stock was not worth anything until a buyer showed up. I mean, that's the false nature of valuations is, I can tell you that my 2017 Buick is worth $35,000, but if I go and sell it, I'm going to find out it's worth about 11. So, I mean, it's what the market will actually bear. So you have to keep your focus on where are we now, where are we trying to get to, and what does that take? And then that's why if you're willing to reprice options and raise money at a lower valuation sometimes is to get back to where you are in the green and it looks really good. We're just looking at some of the things in the chat on different levels. JD, it looks like a lot of people are really early stage, getting ready to raise, coming out of a friends and family. Let's see. Oh, here's a good one. Is there a common option pool percentage we should use when running scenarios, JD?
We always use 10%. There's not a right or wrong answer. I mean, it's and that 10% can be allocated to 20 employees. It can be allocated to 5 key employees. We initially always kind of start with a 10% pool, just in theory, and we've seen that in practice a lot of times. But there really isn't. I will say, I mean, a more key hire, a more key executive, or a more, impact hire sometimes might drive, 2, 3, 4, 5% options and stuff. So that does dilute. There's some companies that only have options for the executive team. There's some companies that want options for all employees. So it varies a little bit, but in theory, and most institutional investors, generally request at least a 10% pool.
Yeah, and I will say the company I was with, the CEO was very much we want as many people as possible to participate in the option pool. And we had, out of 700 employees, I think almost 400 of them participated in some form of option. Yeah. And that was one really well-aligned team. They all really stuck together and marched through it. And it was a long run. We went public in 93, and I think we got acquired in 97. There was 10 years before we went public. So 17-year run.
The importance of that is to that, a publicly traded company. I experienced the exact same thing, Mike, when I was working with a publicly traded company, and I can look at my market price every day, right? And I knew, how my options were doing. The importance for a privately held company and options is to, continue to communicate value, make sure people understand options, and the importance of options. And so it really is a communication device. I will say, more senior level people probably understand the importance and the stickiness of them and the wealth creation that can happen. Maybe, the associates or the new hires don't. And so it's very important that there's some type of, at least at a minimum, annual education on what this really means, what they are, and how they could impact them from a financial perspective. And so, it's very easy to kind of, issue options, but, make sure your employees understand what they truly stand for.
JD, we've got another question here. It's, when do you usually turn on the option pool? The person, I think it was Lana, actually asked, but we've been avoiding it due to managing the logistics of it, but I'd like to start using it at some point.
Well, it's a great question. I mean, we have companies in the early stages utilize options to incent people to come on board that they can't pay a large salary. So a lot of time, and we've had companies actually issue shares as well to people saying, hey, I'm gonna give you these shares, but that's kind of a taxable event because we're giving you at some valuation these shares. Options are not taxable till they're exercised and all this kind of stuff. We'll get into it. But it's a currency, right? So it's a way to basically maybe bring somebody on at a lesser salary with the incentive that I'm going to give you 2.5%, 3% of the existing outstanding shares and options at today's price. Come on board with me and let's go. So we've certainly seen them adopted very early in companies. We've seen them also where there really haven't been a necessity. Maybe it's a self-funded company or they got enough friends and family money in, they're operating, but then they move to either a seed or a Series A, and the investors require it because they want the management team in line to be incented to grow and create valuation. So, but it's a vehicle, it's a currency for early stage companies to attract employees.
So the next question, JD, is, are option pools specific to C Corps, or can LLCs have option pools as well?
Yeah, that's a rabbit hole. But yes, the LLCs can, and there's such a thing called profits interest, and they're a little more complicated, but in theory, they're almost the same thing. It allows you to share in the upside on an LLC. I'm not an expert at it. And I learned that I'm not an expert at it over the last 60 days trying to work through a cap table on a down round on these profits interests. But yeah, there is a vehicle. I will say LLCs and all of that kind of stuff, when you become a member of an LLC, it's kind of different tax classifications and all of that. And so there is more complexities in it, but there are vehicles, and that's back to, visit your good securities attorney to kind of advise you on how to structure it. But yes, it's certainly doable, and we do it all the time.
Well, one last call for questions. This has been really good.
Yeah, I appreciate all the questions.
Yeah.
And like I always say, I mean, I'm at LWBJ. Obviously, Mike's successful as well. If any additional follow-up questions, certainly willing to help. We give a lot of our time back, meet with people initially, and all of that kind of stuff too. And we're big advocates of the ecosystem and the entrepreneurial environment here. So we're here to help.
So coming out of today, you will get an email, probably yet today, with a PDF of the slides you saw today, and the Excel template that JD was using. We just, the thing to know is that it's just an example. Neither of us can be responsible for the math. You've got to do your own work, but it's a way to at least get some ideas of what's going on with your company, and most of all, understand the math. The math's not that complex. It's just unique terms, like pre and post and all those kinds of things. But understanding that math is really beneficial. We'll have the video up for this probably by Monday or Tuesday next week, depending on our editing queue. But we'll get all this online. We have classes on Monday and Thursday next week. Monday is the pitch, which is Sharice Flynn coming back to talk about putting together a great pitch, and she's someone that did a lot of pitching, so she has a really good background on that. And then Thursday, Joe Leo from BrownWinick Law, who has done, I would guess he's done 40 or 50% of the startups in Des Moines in the last 5 years, done their legal work as a securities lawyer. And he's going to do the term sheet, which you now probably have a flavor of why that is so critical to really understand that term sheet.